Welcome to Get Started Investing. In this podcast, we cover all the basics that you need to start your investing journey. Are you joining us for the very first time? Is this the very start of your investing journey? Well, before you dive into this episode with us, our feed is designed to go from the very beginning. So we strongly recommend that you scroll up to the start and hit episode 1. If you're feeling brave and just want to dive in, then of course don't let us stop you. Here at GSI, we unpack all the jargon and the confusing bits, hear your investing stories with the goal of making investing less intimidating, and we want to have a good time along the way. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Great to be with you. We are coming towards the end of the year, but the content does not stop. And you start every episode with the reminder that the feed is designed to go from the very beginning and for people to go back. But if people have stuck with us and they're just new to get started investing, this is a good one to start with. Because all over the world, from the US to Australia and everywhere in between, there's one goal that unites young people: the dream of home ownership.
Fair call.
And more that dream is feeling out of reach. And we've got some numbers to talk to in a second. But the good news is there are ways to invest in property without buying a house. And that's what we're going to talk about today.
Yes, and not just residential property, although that is the dream that unites us all.
That is the dream, yeah.
Don't know too many of our mates.
Keep those offices over there.
Who have much of a dream of owning rural commercial warehouses. But hey, if you had, you would have done pretty well, given what's going on with warehouses at the moment. But let's get stuck in. You did say, Ren, that we are getting to the end of the year. We've only got a couple of episodes left before Ren and I take a bit of a recording break, but we've got an awesome series coming up over summer. It's our summer series with Superhero, and we're going to be hearing the stories of many members from the Get Started Investing community, covering some really big, important questions, major mistakes, lessons, you name it. So it's going to be there for you while you're also taking a break and putting the feed up over the Christmas period. So make sure you tune in.
Yeah, can't wait. We've spoken to some of the members of the Equity Mates community and some finfluencers as well, some names you're probably familiar with. So that should be a great series. But before we get to summer, Bryce, we always do like to squeeze as many things into the year as possible. And there's one more thing that we should remind everyone of quickly before we get into the episode.
That's it. The Equity Mates Awards for 2021, the inaugural awards, are not far from finishing. The finalists have been announced across on our Instagram. Go and check it out.
And
Facebook. But we're looking to recognize and reward some of the platforms and people that have contributed enormously to the Equity Mates community and retail investors. And we're looking for you to vote for your favorite expert investor that we've had on one of the shows across the network. We're looking for product of the year, platform of the year, ETF of the year, community member of the year, and also business leader of the year. So your vote does count. The form will be in the show notes, but also you can check it out on our Facebook page, on the discussion group, and Instagram.
Instagram bio, you know,
name it.
Wherever
you normally find links. So please do go and vote. The voting closes on Thursday, and we'll be then having a bit of an awards ceremony at Equity Mates HQ next week.
Bryce is designing that. I'm a little bit apprehensive about how it's all going to run, but he assures me it's going to be good. But before then, we're here to talk houses and property investing. And let's start with this year, because it has been a crazy year around the world for housing. Wherever you're based, you've probably heard local news about house prices. But rest assured, this is a global phenomenon that we're witnessing. So leading the pack, I think, is New Zealand. Mm-hmm. Between July 2020 and July 2021, 31% increase in the average house price.
Yeah.
Okay, well, I was expecting more of a reaction from you.
Crazy.
31%.
Yeah. I mean, it's all relative as well, though. In my, like, 31%, great. Markets also sit similar. Like, assets are just going nuts. When we've spoken about this before, like, it's just across the board, everything's going crazy. And unfortunately, for those looking to get into the housing market, these numbers aren't going to be very news aren't going to be nice to hear.
Yeah, okay. Well, if that number didn't surprise you, the rest won't, so I'll go through them quickly. The next highest in the countries that I looked at was Australia between September 2020 and September 2021, 20.3% average increase. But Sydney led the charge, 28.9% average increase. America, not far behind, between August 2020 and August 2021, 19.9% average. But some of the sub-markets, like some of the regional areas in America, are just so hot.
Yeah.
Yeah, it's just like Silicon Valley money spreading across the world because they can work from home. That's an overly simplistic explanation, I am aware. But and then even in the UK, not as much, but between August 2020 and August 2021, 10.6% increase. Again, like that's more than the stock market averages in a year.
Yeah. Well, I am looking at the S&P 500 because some of those numbers there were March 2020 to March 2021. And
No. They weren't.
What were they? Well, there was one there, wasn't it? July 2020 to July 2021. Let's have a quick squiz on that.
Because, the reason that I jumped in there was if you were going to do the March 2020 to March 2021,
70%.
I know the game.
Yeah. So you're looking at, 35% for the S&P 500 for that period of time. So
not bad. This episode is not going to devolve into a investing in the stock market via investing in property discussion.
No.
I think this is just you can invest in both.
Cash 0.01.
Yeah. Gold, probably flat. But look, so that's a this year phenomenon. We're living in a world of low interest rates, of money printing around the world, and house prices going crazy. But longer term, housing has been an incredibly strong investment. And I've only pulled numbers from Australia here. It does actually differ around the world. But in Australia, last 25 years, 10.1%.
That's good.
That's great.
Yeah. That's why people want to get into property.
Yeah. And even with prices so high, property remains attractive for two reasons. The two reasons that we invest.
Capital growth.
Yeah.
And getting a bit of an income stream.
Yeah.
That's it.
Well, so if you look at the options for more like based on their risk profile to getting paid an income, they pay you more than bonds and they're less risky than stocks. Property is. And then capital appreciation, everything we've just been speaking about, the price just keeps going up.
Yeah.
So the two ways you make money is investing. You can sell it for more later and it pays you while you own it. Property ticks both boxes.
Yeah, if you're investing. Home ownership, you're not getting a yield. I think a lot of people, you're relying on that capital appreciation.
And so what we mean there is like if you're living in it, no one's paying you rent.
Yeah. You're not actually going to see a return on that until you sell it, hopefully. And if you're getting 10% over 25 years, you're going to get the capital growth when you go to sell. But it's not like stocks where you can buy it and start getting that dividend straight away. But if you're investing in property, then that nice yield coming through from people renting tenants, it or whatever it may be. Yeah.
And I think the other thing to note here is that governments around the world have incentives to keep property growing. Unlike stocks, where the majority of voters, important qualification, have like this emotional and deep-seated connection with their housing. Scott Morrison doesn't think if the stock market falls 15%, I'm going to lose the election.
Yeah.
But he very well could think if the housing market falls 15%, I might lose the election.
Yeah.
And that creates an incentive structure, and we see it in the plethora of programs to support housing. And I think what New Zealand have done, where they've said housing's too hot and we need to slow it down, is impressive in its political bravery, if not for anything else.
That's classic New Zealand.
Yeah,
they're good at that, leading the way. So, look, there are ways in which we as retail investors can get access to property without having to buy a house. And we're going to go through 4 of those ways now. Just to name them, we've got listed options on the stock market. So we've got REITs, real estate investment trusts, and ETFs. There are a couple of unlisted options that you can do, as well as a bunch of new apps and platforms that are coming to the market. And then there is another way that you can jump in through the sort of the picks and shovels way. And that is also through the stock market as well, investing in companies that are exposed to the housing market. So, Ren, let's start with REITs, real estate investment trusts, and ETFs.
Yeah.
The listed option.
So the great thing about the stock market is you can invest in more than stocks. You can invest in a variety of asset classes, including property. So according to a list we found, there are 80 investment options listed on the ASX that are in the real estate industry. 30 of them are in the management or the development of real estate, not owning real estate per se. And then 50 of them are listed as real estate investment trusts. And a real estate investment trust is basically a company that owns property, and you can invest in that company. And they, similar to an individual person who buys a house as an investment, a real estate investment trust has billions of dollars of property as an investment, and they make money as that property gets revalued higher and higher. And they also make money from tenants, from companies who are leasing offices from them, or warehouses, or any type of property you can think of. So there are 50 REITs listed on the ASX. That's heaps.
That is heaps, yeah.
So many to choose from. And they cover a variety of different parts of the market. You'll get like industrial, you'll get office, you'll get a mixture. One thing that you don't get, and I think there's an opportunity there for someone to fill that gap, is a pure play residential housing REIT.
Yeah, so let's make this clear. All of the REITs that we're talking about all involve, as you said, different types of property, commercial, industrial, warehousing, you name it. But there's nothing that if you're sitting back going, I just want access to the hot market of housing, residential housing here in Australia, there is nothing that you can invest in through the stock market that will give you that access.
Yeah.
Yeah.
So to give you an idea of what you can access through the stock market, we've pulled out the top 5 REITs in terms of market cap. So these are just the biggest. No, this is not us saying they're the best in any way. They're purely the biggest. So the biggest in Australia is Goodman Group. They have over $50 billion in property that they own, 3.4 million square meters, and they own property in Australia, New Zealand, Asia, the UK, Europe, so most of the world. Maybe even the US now as well. But so they're massive. So if you just want to invest in property globally, there are options like Goodman on the ASX. The next biggest one is Scentre Group, which a lot of people will be very familiar with but may not know the name. Scentre Group own all the Westfield shopping centres across Australia and New Zealand. So if you've ever shopped at a Westfield, that shop that you shopped at was paying rent to Scentre Group. And you could invest in Scentre Group and, be a shareholder and benefit from that rent payment. What about some of the other big ones?
Scentre got absolutely slammed during COVID, as you can imagine, with the impact on people going to shopping malls. Some of the others, so Stockland Corporation, so they have shopping centres, housing estates, industrial real estate, retirement housing even, and they have a pretty diversified real estate investment trust. So again, it's not just an investment in one type of real estate. They span a whole bunch. One that you may have seen in some of the big capital cities as you drive around and see all the big skyscrapers being built is Mirvac Group. They not only have investments in and own property in residential, retail, office and the like, but they also design and develop and manage a whole bunch of real estate. So they're a true end-to-end real estate play. So yeah, they're massive.
I think the important thing to stress, because with both Stockland and Mirvac, you mentioned that they have some residential, and Mirvac we all know for those big apartment buildings.
Yeah.
So that you can get exposure to the residential housing market, but there's no pure play, just residential. The last one to round out the top 5 is Dexus. We interviewed the Dexus CEO earlier this year on the Equity Mates podcast, so you can go and listen to that episode. But they've got about $32 billion in office and industrial real estate. So yeah, there's a bunch of options to choose from. They're the real estate investment trusts, and basically they're a company that own property, and you can invest in that company. There are also ETFs. So there's a number of ETFs that exist in the market that essentially buy property, but the way that they do it is that they buy the real estate investment trusts.
Yeah.
So the ETF will buy a bit of Goodman Group, a bit of Centre Group, a bit of Dexus, a bit of a number of the other REITs, and then you'll get, I guess, like the average of them all, the market weighted average of them all.
A classic example is VAP. I'm pretty sure the Vanguard Australian Property Securities Index or whatever it is, and it's exactly that. Has a bit of everything.
Yeah. To not just be Vanguard centered, Van Eck have one, MVA, but there's so many out there. There's, State Street have a listed property one that just takes the ASX 200. There's so many out there. So you can do some Googling if you want to see your options. But basically, the way to conceptualize it is that REITs are the companies that directly own property, and then ETFs sit above them and they own a number of different REITs. And both of those you can invest in directly through the share market. So that's option 1. If I can't afford a house yet, but I want to get exposure to the property market, I can do it through the share market. Hit me with option 2, Bryce. Option
2 is your unlisted approach through managed funds. Just like you can invest in the stock market through a listed way, you can give your money to a fund manager who is investing on behalf of their investors in the property market. It's not done through the stock market. You go off market, find a fund manager that you think is an expert in investing in property, and then they'll use your money to go and invest in a bunch of unlisted property.
Yeah. Now, I think this is basically just a tick and flick exercise for us, because the thing with unlisted funds is they generally have quite high minimums, like a minimum investment of 50 grand or 100 grand. If you have 50 grand or 100 grand to invest as a minimum, you're probably well on the way to actually getting on the housing ladder yourself. The only thing I want to mention here is we mentioned with listed funds, there's no pure play Australian residential fund. There is an unlisted fund or 2 unlisted funds I could find that are pure play Australian residential. Crescent Finance, never heard of them before, but they have a Crescent Growth Fund and a Crescent Income Fund, both of which are purely focused on residential property. So just wanted to mention that, but I think unlisted for me is not really the route I would be going down if I wanted to get exposure to property, just because 1, the paperwork, we hate paperwork here, and 2, the incredibly high minimum investments kind of negate the whole point of what we're trying to do here.
Yeah. But as you said, if we're talking about how you can do it, that is an option if it's right for you. Before we close out the other 2, which is all the apps and that are starting to come to the market.
Yeah, the next 2 are the exciting 2.
And then closing out with the picks and shovels, the companies that are exposed to the housing market. We're just going to take a very quick break to hear from our sponsor. So as with brokers, Ren, and access to the stock market, there's now more and more apps coming to property market, giving people more of an opportunity to access residential property without having to throw down a 20% deposit. That's right.
There's some pretty cool functionality coming to the market. So let's go chronologically. The first one, the earliest one I'd never heard of before. I'm interested. Have you ever heard of Domacom?
No.
Yeah. So this, I think, was the first one, established in 2011, and it is a crowdfunding model where investors are able to buy a fractional share of a residential property. So, I think the way it works is Domicom buys it. They buy. What's your address?
No.
They buy a house, and then you can buy a fraction of that, and then you get a fraction of the rental income, and if it gets sold later, you get a fraction of that. So that's essentially that was the first one, Domicom. I actually hadn't heard of them, but established in 2011, still kicking around. Then one that I had heard of was started in 2014, BrickX.
Yeah.
Have you heard of them?
Yeah. I remember they reached out to us, I think, when they started. Or
No, not when they started.
When we started.
Oh, okay.
Yeah. They've been around for a while.
Yeah. So they use a similar crowdfunding model. They term themselves a stock exchange for residential real estate investments. And basically, it's a minimum of $250 worth of bricks or units in a property trust, but you can buy and sell units in that trust and, I guess, get exposure to the property market or get exposure to particular properties from as little as $250. So that's pretty cool.
Yeah, I think the advantage with that one was the ability to sell in and out without having to sell the house. Okay. Was their kind of, at the time, I'm sure a lot of the other platforms now also give that ability, but at the time that was one of their whole things.
Yeah, we should be very clear that we don't use any of these platforms, no. But we wanted to do an episode to talk about them, but our knowledge is limited to really what we're talking about. So if you want to actually compare BrickX and Domicom and say what are the differences between the two options, do your own research. The last option that takes a bit of a different approach to the crowdfunding model is Proppy.
Yep.
Had you heard of them?
No.
So the first I heard of them was for our Equity Mates Awards. They got nominated a couple of times in terms of Platform of the Year. So basically they are I guess you would say a marketplace that brings together people that are interested in buying a property together. Yeah. So rather than BrickX and Domicom, where the actual investment and the owning is centralized on the platform, Proppy just is a place where people meet and then they go and buy a house together by the looks of it.
Share the deposit.
Bryce goes on and says, I'm looking to buy 50% of a house in Vaucluse. That's probably where you're going to end up living one day. And then I go on and say, I see Bryce's, he's put that up and I say, well, yeah, I want to put the other 50% in, and then together we go and buy the house. So a pretty cool model.
Yeah.
Requires a bit of trust.
I think personally, it's probably the one that I would lean towards. And I'm not saying that this is a recommendation of any sorts, but you own the underlying asset at the end of the day with that one. Yeah.
For me, it's just like, how do you decide who gets to live in the house? Or is it just you have to rent it out? Well, I guess you just agree between the two of you, but it's like,
you'd want to make sure whoever you get, the trust element is massive with this sort of stuff.
Yeah.
Like, you don't, all of a sudden someone could turn around and be like, I want to sell, and you're like, I don't want to sell.
Yeah.
How do you work that out?
Yeah. And if so, my example was 50-50, but I guess if you had said, I want to buy 70% and I want someone else to buy 30%, I guess you as the 70%, you just have majority say.
I don't know.
Yeah.
And the other things with the BrickX and Co, and again, don't know too much about it, but I question the quality of the properties on the platform, because if are they going out and bidding up as crazily as someone who's desperate for these properties? Do you know what I mean? Like, how good are the properties that you're getting that these platforms are buying? And do your own research. I have no idea an answer to that question, but these are the things I would think through.
Yeah.
It's easy to look at it from a high level and say, oh, this is awesome, I can buy a brick in a house for $250, but is it the best place you can put that $250?
Yeah. Now, if you're listening in the US, some of the names to look for are companies like Fundrise, Realty Mogul, and Peer Street. So similar functionality, like wherever you're listening around the world, there will be similar crowdfunding platforms for property that are emerging. two big watch outs for me when it comes to these apps, because I love the innovation. I think the innovation's great, but two big watch outs. First of all, fees.
Yeah.
We hate fees here at Equity Mates, and the fees can be quite high. I don't want to pick on them, but it's the only data that I pulled, so I'm going to pick on them. BrickX charge 3.15% and then have property management fees on top of that. Now, that's a lot higher than the share market, but I think to be fair to these apps, you got to compare apples to apples, and you got to compare investing in these property crowdfunding platforms with investing in property itself.
Yeah.
Because there's a lot of fees and charges and taxes and costs that come with investing in property. But the first watch out for me is fees.
Yeah.
Second one is liquidity, because a lot of these apps are really taking what's worked well in the share market, these sort of micro investing, easy to use, accessibility focused apps, and then they're applying them to property. But the share market is incredibly liquid. There's millions and billions of dollars and shares changing hands every day, and it's easy to find a buyer or a seller. Property is quite illiquid. It's slower to sell and it's harder to find a buyer, and sometimes you don't find a buyer. And so...
Not in this market.
Not in this market. No, that is true. That is true. So just when you're looking at your different options on these apps, just understand how easy it is to get out.
Yeah, agreed. And I think that's changing with them. But yeah, I completely agree. You don't want to go in there and find that you're in until the app decides to sell that house.
Yeah, so, and to be fair, I think Datacom has like a liquidity function to like help add liquidity to the market. But at the end of the day, like it's all additional mechanisms they're trying to build because the underlying asset isn't as liquid as the stock market. So that's just a watch out for me. Yeah.
Nice. Well, let's close out by having a chat about the companies, Ren, that you can invest in through the stock market. Back to the stock market, closing out with that. Companies that you can invest in that don't own or buy real estate but are exposed to the housing market and obviously will benefit from the rising tides of house prices and building and development and everything that goes in with it. So here in Australia, two that come to mind, REA Group and Domain, or realestate.com, one of the most recognizable online brands, and a crazy stat, 145 million visits in the month of October to REA Group, realestate.com, as everyone was.
Just to be clear, it's .com.au.
Realestate.com.au.
I've just checked what realestate.com is. Nothing. Like, doesn't go to a website. Surely someone's trying to buy that.
What the...
But yeah, like how we have discussed these two companies, and if you're in the US, you're thinking Zillow or I think Open Door or Realtor. There's a few over there. They're toll roads for the modern property market. If you want to buy or sell a house, you're using these platforms.
Yeah.
They clip the ticket on almost every transaction because you need to list on these platforms. And importantly, as house prices go up, their ability to charge more goes up because the as a percentage of your expected return, their fees are smaller, so they can increase their fees. And really, you're not going to sell a house in Australia if you don't list on these platforms, or at least on REA, on realestate.com.au. So for us, that's like a business that is essential to the market and can benefit from the market going up. So that's another way to get exposure to the market.
Yeah. And if you are interested in hearing more about REA Group, we are fortunate enough to be able to speak with the CEO, Owen Wilson, and he will be part of our summer series over on Equity Mates Investing Podcast. So make sure you go and check that out. We do a bit of a deep dive on the housing property market here in Australia and REA Group. So Ren, to close out, it's a good point to mention that there is a big difference between investing through the means that we've just spoken about and obviously taking a mortgage and doing it yourself, and that is the power of leverage.
Yeah. Buying a house is seen as this like big personal finance win, and it is. It's really impressive. But a big reason that it sets you up financially is because it's the only asset that the banks will allow you to borrow 80 to 90% of the value of to buy. And then you get a whole bunch of tax advantages from having a mortgage and all of that stuff. Any of these options that we've spoken about today, you're not borrowing 9 times what you're putting in to buy, more.
Yeah.
So like that's just the only thing. You don't get that leveraged return that you do in property.
Yeah.
Yeah.
But you can, in the stock market, take out some leverage if you want to. And there are many means to do that.
And that's a whole other conversation.
We'll leave that for now. But Ren, that brings us to the end of our episode. It's certainly, as you said at the top, a dream for a lot of us to get into the housing market. And if you are feeling a little overwhelmed and left out, I hope that we've been able to demonstrate that there are other ways that you can tap into not only the residential market, but plenty of other property options, both here in Australia and around the world. So we'll leave it there. We're coming next week with our final episode for the year before we go into our summer series through to the end of Jan. And we're closing out with another community member interview with one of our new employees here at Equity Mates, Darcy. So we'll pick it up next week. Otherwise, have a good week, and Ren will talk next week.
Sounds good.